Hello, everyone, and welcome to MOOC 11 Session 2. Are you excited? Because I'm very excited to be teaching the 11th repetition of the massively open online course for the University of Nicosia's master's degree in digital currencies. This is the second session. With me today, I have my trusty teaching assistant, the Owl, and the Owl will ask the most important question. Who is Satoshi Nakamoto? But I won't be answering that question because I don't know. So let's go straight into the other questions. First question comes from Mario. Can you explain the life cycle of a transaction from the point someone sends a transaction from their wallet until the point it is confirmed on the Bitcoin blockchain? That's a great question, Mario. Let's get right into it. Your wallet constructs a transaction by accumulating the Bitcoin you have in your wallet and assigning it a destination address or multiple destination addresses, and then signing that transaction. At that point, your wallet transmits that to one of any of the nodes it is connected to. In fact, it will start, but then it will transmit to all of the nodes it is connected to. A wallet might be connected to 1, 2, 3, 4, perhaps 8 different nodes. It will transmit the signed transaction. These other network nodes, which may be other wallets, they may be mining nodes, they may be nodes belonging to exchanges or merchants or people doing e-commerce or people just running a node for fun. They will each receive this transaction from your node. The first thing they will do is validate it. Every node validates every transaction. When they receive this transaction from your node, they don't know if your node created this transaction or if it was just forwarding it, because they're receiving transactions from all of the nodes around them all the time. That's how transactions are propagated. So they receive this transaction, they validate it. If it is valid, all of the amounts are correct, it has the necessary fee, it is not trying to spend something that's already been spent, et cetera, all of the rules of consensus. The signatures are all valid. It fulfills certain criteria as to the size of the transaction, the size of the scripts within the transaction, et cetera, et cetera. Everything is validated by each of the nodes that receive your transaction. Only then do the nodes that received your transaction then send it to all of the nodes they're connected to. So you send it to all of the nodes you're connected to. They each validate it. Then they send it out to all of the nodes they're connected to, which send it out to all of the nodes they're connected to, always after validating. Until eventually, through this process of flood propagation, as it's called, the transaction will be sent to every node in the network. Some of those nodes will be miners. Now, let's talk about what happens when the transaction is validated on each node it's received, whether that's a mining node or not. All of the nodes, including your own, maintain a pool of unconfirmed transaction. Think of this as a giant bucket where all unconfirmed transactions go to wait to be confirmed. All nodes keep track of what transactions they've seen that have not yet been confirmed, and they store them in this pool of transactions, which is called the mempool. Of course, important to understand, there isn't one mempool. There isn't the mempool. There is a mempool on every node. And because of differences in timing and differences in propagation, any one mempool on any one node is not going to have an identical set transactions as every other mempool, although they will probably have 99% overlap. The same transactions, perhaps received in a different order, will probably be in most of the mempools in most of the nodes. On mining nodes, the mempool serves a very important purpose. It serves the purpose of providing transactions for the miner to add to a new block. So if you're looking now at this from the perspective of one of these mining nodes, they have just found out that a new block has been found, which means the race is on for the next block. So in order to participate in that competition as a miner, they have to construct a block that they will try to solve the proof of work on. And they do that first by constructing an empty block. That empty block has a link to the previous block, the one they know about most recently. to establish its position on the chain. It has a timestamp, it has some other information in the header, and it has at least one transaction, which is the Coinbase transaction that pays them. When they construct their own empty block, the miners put their own address as the destination payment in that block. Now, this block is not valid. It doesn't have proof of work. It also doesn't have any transactions. At this point, they will send that block to all of their mining equipment to start trying to find a proof of work, but they'll now also try to add transactions. So they reach into the pool of unconfirmed transactions, and they start looking for the transactions that pay the most fee. They're looking for transactions that pay the most Satoshis per byte, so they can maximize the amount of profit they can make by filling this block. So they start pulling transactions out based on which one has the maximum fee. They've already validated all of these transactions. That's why they're in the mempool. They don't get into their mempool unless they've been validated. And they start putting them into this new block. We call that a candidate block because it hasn't yet been proven. As they add transactions, the block gets bigger. And every time they add something, they send it back to the mining equipment so the mining equipment can try to find a proof on the block. If they're lucky, at some point after doing billions of hashes, their mining equipment finds a nonce that creates a block hash that is below the target difficulty, which is therefore a valid proof of work, and immediately tell the node of the miner, we found a block. And the mining node then propagates that block out to every node that it's connected to. In the same way that the transactions reach the mining node, the block leaves the mining node and is propagated back out to all of the other nodes on the network. So both transactions and blocks are propagated through this flooding process. When other miners receive this block, they validate it as quickly as they can, and then they immediately stop trying to find a block and start again with this new block as the parent, because they know they lost the previous round of competition. Somebody else won. Therefore, they need to start again. All the nodes back to your wallet receive this block. As they receive the block, they validate it, just like they validate every transaction. As they're validating it and they're looking at the transactions that are in there, they go, this transaction was in my mempool, but it's now I see in a block. So I'm going to take it out of the mempool and consider it confirmed. So they take transactions out of their mempool once they know that that transaction is confirmed. And this block will propagate all the way back until it reaches your wallet, at which point your wallet will know that its transaction has one confirmation. And then the process continues. So that's the entire life cycle of a transaction. Let's check in with the chat room and see how things are going. Very good. Everybody can still hear me, can still see me. We're doing well. Sergio asks, can you show an example of two blockchains with different computation work? Is the level of work applied on the blockchain stamped on the last block of the chain? Sergio, the level of work applied on the blockchain is stamped, in fact, cumulatively in every block. Every block contains a proof of work. The proof of work is the hash of the block has a certain number of binary digits equal to 0 at the beginning of the hash, meaning that in binary terms, that means that the hash of the block is less than a certain number. That number is the target difficulty. So when you have a target difficulty, let's say it's this number here, in order for the block to be valid, it has to get under the target difficulty. Its hash has to be less than the target difficulty. And if all the possible block headers are described by the range of 0 to the target difficulty, as the target difficulty gets lower, the chance of your random hash that you're finding falling under the target difficulty gets more and more difficult, right? The lower and lower probability of a random hash landing below the target difficulty, and of course above 0, because all of these hashes are above 0. So what you're trying to do is hit a random number that is less than another number, which is the target difficulty. And that target difficulty, as it gets more difficult, gets closer and closer to 0, and you're trying to get in there. So on each block, you can calculate the hash. And the hash shows you what number that is, which is obviously below the target difficulty if it's a real verified block, a correct block with correct proof of work. And by looking at how low that number is, the hash, you can estimate approximately how many hashes per second it required in order to produce that block. Because the number of hashes that it takes to randomly land on a specific number, assuming that as soon as you landed on a number that was less than or equal to the target difficulty, you told everyone by announcing the block, that means that block, the chances of you finding that number are 1 in 2 to the 256, and minus the target difficulty. So you can calculate exactly how many hashes are required to do that. And depending on how much hashing power is operating on the blockchain, you can also calculate how long it would take on average for the current maximum hash rate you have in the blockchain, in the network, to be able to find a solution to a block. So every block shows the proof of work. Therefore, every block has the difficulty in the block itself. And if you add up all of the cumulative difficulty, or all of the cumulative proof of work demonstrated by each block, then you have the sum total difficulty of that chain. Now, if 2 blocks are found simultaneously, or 2 or 3 blocks in a series are found simultaneously in different parts of the network that are part of a fork in the consensus. So you have one parent block and then 2 blocks that are found simultaneously on different sides of the network, which are competing for the same position. Perhaps even 2 more blocks after that, and you've got a divergence of 2 blocks. How do you choose this one or this one? Well, you add up the difficulty from the parent and you say, this chain has this much difficulty, this chain has that much difficulty, and the one with the greatest difficulty wins. That's how each of the nodes decides which chain to follow. So this calculation happens with every block that's discovered. And each time a block is discovered, each node does a calculation to see which is the greatest difficulty chain, if they have more than one options, and what is the greatest cumulative difficulty in order to select what is known as the best tip. David asks, how and where is the target difficulty set? What does greatest difficulty mean? The target difficulty is set everywhere, meaning that every node in the network at the same time calculates the target difficulty for the next block. And they do that during the retargeting window, which happens every 2016 blocks. Every 2016 blocks, the entire network, meaning every node in the network, when they receive the 2016th block in a row, or any multiple of that, they then calculate what will be the difficulty for the next 2016 blocks, starting from block 2017 up to 2016 blocks later. And they calculate that by an equation where all of the inputs are the same for every node, and therefore all of the nodes will arrive at the same answer. Assuming they're all looking at the same chain, then all of the nodes at 2016 will calculate how many minutes it took to produce the last 2016 blocks. Now, the average time should be 10 minutes. Therefore, the average time to produce 2016 blocks elapsed from the first to the 2016th block should be 20,160 minutes. They will then divide the actual time that has elapsed based on the timestamps within the blocks with the time that should have elapsed, or 2,160 minutes, and they will calculate the deviation in time. So, because every input into that equation is the same for every node, they'll all arrive at the same answer. Let's say that instead of 20,160 minutes, it took 40,320 minutes. That means that the number of blocks took twice as long to find, which means the difficulty needs to be lowered by 50%. So they all do the same calculation. They all arrive at the exact same proportionate amount of difficulty that needs to change, and they adjust the difficulty target by exactly that proportion. So difficulty will go up or down by whatever percentage the number of minutes elapsed versus the number of minutes that should have elapsed is. All right, we seem to be having some difficulties with video lag. Let me see if I can make an adjustment and see if I can help. Testing, testing. I'm going to wait for 30 seconds. Maybe you can tell me if this has fixed the audio-video lag. Seems better. Very good. David has a second question, which is the follow-up. How does the system ensure that a new block is generated every 10 minutes, even though it's random? Well, very simple. The chances of finding a new block can be determined by the target difficulty, meaning when you change the target difficulty, you're changing the probability of finding a new block for that amount of hash power. And that's a linear relationship, which means that if you decrease the target difficulty by 10%, it becomes 10% harder to find a new block, which means that for the same amount of hashing power, you'll find a new block 10% slower on average. Or if the hashing power has gone up by 10% and you increase the difficulty by 10%, then the average block should be found on average every 10 minutes. And because the calculation of how to change the target difficulty is by adding up the ideal time of 10 minutes over the past 2016 blocks and adjusting proportionately for the difficulty, that automatically recalibrates the entire network to target 10 minutes as the goal by changing the probability of finding a block linearly. And this decision, as I mentioned before, is made on the same block, the 2016th block, for the same next block, the 2017th block in sequence, by every node at the same time using the same inputs, which result in the same answer, which is applied by all blocks. And then all of these nodes use that new target difficulty to check the next block. So when they see the next block, they expect the next block to comply with the new target difficulty. They expect the next block to reach the new target difficulty. So they use what they just calculated to validate the difficulty of the next block. We have another great follow-up question about this in terms of mining. Is it still profitable to mine Bitcoin now that the price has dropped? And this is a common question, but also a common misconception. Even supposedly serious analysts, organizations, and financial organizations get this wrong all the time. You can find articles in the Financial Times, in the Wall Street Journal, research reports published by JP Morgan Chase that say things like, it is no longer profitable to mine Bitcoin, or it will not be profitable to mine Bitcoin soon, which you can translate into common English as, I don't understand how Bitcoin works, but I like to write articles about it anyway. Basically, the way the difficulty retargeting algorithm works is that it creates a dynamic relationships between the behavior of the miners in that market and the issuance of new blocks. Think about it this way. At any moment in time, there are thousands of different mining farms operating thousands and thousands and thousands of different pieces of mining equipment, miners, hardware miners, ASIC miners, as they're known. Now, imagine you're operating one of these farms, and within your factory or warehouse, you probably have a variety of equipment. You might have 80% of your equipment being the very latest mining equipment that is efficient at a certain cost of energy and produce a certain number of hashes per kilowatt of energy consumed. And that's how you estimate the efficiency of your mining equipment. And it's not all going to be at the same level. Some of it's going to be less efficient, meaning it requires more kilowatts per hash to produce hashing power for the network. Now, at the same time, you're thinking about the electricity costs you have as an input into this equation, as well as various other expenses, operating expenses, maintenance expenses, staff expenses, the maintenance expenses to rack and mount and dismount and recycle equipment, all of these things. You have some kind of electricity cost, which may be on a 3-month contract or 6-month contract or even a daily contract. That gives you a certain price per kilowatt. And based on that, you can estimate whether at the current level of difficulty and the current level of the Bitcoin price, your equipment is profitable or not. And the answer you're going to get is going to be different for different classes of equipment. Less efficient equipment is going to become unprofitable earlier than more efficient equipment. So you look at your warehouse and you say, okay, as of today, this batch of miners here is no longer profitable, which means that the overall cost, specifically and most importantly, the biggest input, the cost of electricity that they consume in order to produce hashes does not produce enough Bitcoin at the current price to pay for that electricity. Therefore, the longer they're turned on, the more loss I'm making. So you've passed the break-even point. That specific group of miners is no longer profitable. You may have in your warehouse other miners that for every kilowatt of electricity they're consuming at the current price are generating enough Bitcoin from mining on average that they pay for the electricity and then make a profit and pay for all of the other maintenance costs and continue to make a profit. Those are profitable. Some of your equipment isn't profitable. What do? You turn that equipment off. It's very simple. You turn that equipment off because as long as it's working, it's consuming electricity without being able to pay for that electricity. So you turn off just the equipment that's not profitable and you leave on the equipment that is profitable. Now imagine this happening as a ripple effect across the entire industry. And this is something that happens on a day-to-day basis. Miners all around the world, thousands of them decide to turn off or turn on new equipment. And they're constantly replacing equipment. They have truckloads of ASIC miners in their loading docks that they have to mount and install. And at the same time, they're taking out old miners that are no longer profitable. So there's constant churn. Now imagine as an industry, the most profitable of mining farms, the ones that have the lowest operating costs, the best location, the best electricity price, the lowest staffing costs, they remain profitable, while others, even perhaps at the same electricity cost, because of higher maintenance, staffing, location costs, etc., are no longer profitable. They may turn off their entire warehouse. And what that does is, when they do that, it reduces the hash power across the entire network. The amount of hashing happening drops. And you will see that happening all of the time. It goes up and down and changes. It's highly volatile. So it changes a few percentage points every hour as the hashing power, as new machines are turned off, new machines are turned on, old machines are turned off, warehouses suffer power cuts, new warehouses are turned on, etc. If a large number of miners are finding it unprofitable and turn off their least profitable equipment, that drop in hash power causes the difficulty retargeting after 2 weeks. When the difficulty retargeting happens, the miners who are still operating will be more profitable because as the difficulty gets lower, their hash power generates more Bitcoin for the same amount of electricity used, right? So as the difficulty gets lower, their mining equipment becomes more profitable. Perhaps it gets so profitable that some of the equipment they turned off is now profitable again, so they turn it back on, which causes the hash rate to increase, which then in the next difficulty targeting makes it less profitable, which effectively causes people to take machines on and offline as the profitability changes. Now, the same thing happens if the price goes down. If the price goes down, that pushes a certain class of equipment into non-profitability. And as a result, the older equipment in the mining network gets turned off, which then causes the difficulty to drop, which finds equilibrium. So supply and demand are constantly finding equilibrium at exactly the right level of profitability, where the average miner is profitable. And how do we know the average miner is always profitable? Because they're still running. If they weren't profitable, they would have turned off. So the average miner is always profitable because the average miner that doesn't exist, it's a statistical fiction, leaves their machines on, which is why we have some of the profit remaining. Now, some of the miners are not profitable. They turn them off. Some of the new miners are more profitable, so they turn more machines on. And anytime the price moves, that entire equation recalculates, causing the least profitable miners to turn off, the most profitable to keep operating, and the difficulty to retarget to keep everything in equilibrium. On average, the profit margin of a miner should be near zero. And the reason for that is because in economics, a perfect market is where, as supply and demand reach equilibrium, the price approaches the point of cost as closely as possible, and the profit margin goes to zero. The reason for that is because if it's above zero, the profit margin, then that attracts more people to join the market, which increases the hashing power, which increases the difficulty, which drops it back to zero. So it should always, on average, hover around zero. Most miners should be operating just about break even on average. The problem is the average is at the center of a bell curve of miners, some of whom are very profitable and some of whom, the ones are about to turn off, are very unprofitable. And that's how the industry works. The price can never make mining unprofitable because the unprofitable miners turning off makes the rest of the miners profitable again. Hopefully that answered your question. Very good. And the audio is working well now. Hard Fork Cafe made a very important comment, which is, I discussed this purely from an operating cash flow perspective, which means that price goes up, price goes down, and you calculate it based on the kilowatt and the current price of Bitcoin. Of course, some miners are going to take risks, and they're effectively going to mine at a loss today, anticipating that the Bitcoin price will increase in the future, and they'll make their profits by having excess Bitcoin to invest. Now, this is a very risky proposition, and you can't do it at scale. And the reason you can't do it at scale is because you won't have Bitcoin to keep for the future, because you will have to sell all of it to pay for electricity unless you have another source of income. But on a small scale, for small miners, that also applies. Next question comes from Jan. Jan asks, are non-mining nodes validating transactions? If yes, what prevents them from validating fraudulent transactions? That's a great question, Jan. All nodes are validating transactions. all nodes are validating blocks. All transactions get validated by all nodes. A node does not propagate a transaction unless it validates it first, meaning that if you send a transaction into the network, the first node you give it to will validate it before forwarding it on to anybody else. The truth propagates, lies stop propagating. The first node to find a transaction that is invalid the moment they receive it and fail to validate it by the rules they're following, they will reject that and not propagate it. But here's the important trick. They will not only reject it and fail to propagate it, they will punish the node that sent them that transaction. They will say, according to my rules, you sent me a lie. So your node is now going into a timeout. I'm not talking to you for 12 hours. Bye. Now, I don't know what the timeout characteristics are, but there's a mechanism within at least Bitcoin Core clients, but most clients, most node software out there, that progressively makes the timeout worse. The first time you lie to another node, it may assume that you haven't upgraded recently, and it's going to reject your transactions or blocks and say, you're propagating lies. I'm not talking to you. Timeout. Second time you do it, it will give you a longer timeout. Third time, it might kick you off the network completely. Basically, stop talking to you, disconnect, and not accept connections from your IP address again. This mechanism ensures that nodes that try to propagate transactions that other nodes consider a violation of the rules find themselves very, very quickly isolated from the network. We've seen, in fact, during forks in the network, where the network will automatically split in half, where the nodes that are supporting one fork versus another stop talking to each other, because the moment they try to propagate to each other something that the other side doesn't consider valid, the other side stops talking to them. So for example, if you have a fork where a group of nodes decide to use new rules that are not valid to the rest of the network, they will find themselves cut off from the rest of the network. The rest of the network will ignore all transactions. So that's what prevents any node from validating fraudulent transactions and propagating on the network. The other nodes stop trusting it. Second question from Jen, similar. If nodes could propagate fraudulent transactions, couldn't there be another Bitcoin blockchain where the miners just aren't truthful and write a higher mining difficulty in the block, therefore making it appear that their chain has more proof of work? What I just said about how transactions propagate also applies to blocks. So those miners, when they try to propagate these blocks, which have a different set of difficulty than what is expected by the rest of the network, or they have fraudulent proof of work in them that is not validated, then every node they try to propagate this new block will not only validate it, fail to validate it, and reject that block, and therefore ignore it, but they will also penalize the node that sent them that block and say, you're a liar, timeout, which means that the miners trying to propagate these blocks out are held in check by the nodes that refuse to propagate those blocks further. This is a really important concept because it underpins the ability of non-mining nodes to be participants in consensus, especially non-mining nodes that form economic interests within the network, such as, for example, the nodes of merchants and exchanges and large wallets. Because if you can't propagate your blocks to these nodes, that also means you can't sell your coins on exchanges in order to pay for electricity. And therefore, even nodes that you have at home on your little machine, checking blocks and propagating them or refusing to propagate them has an impact on consensus. If all of those nodes decided that a block was not real, was not valid, and refused to propagate it, that miner would either have to try to propagate their blocks directly to the nodes of an exchange, or find an exchange that still believes them that this is a valid block. Otherwise, they mine the block, they spend the electricity, but nobody propagates it anywhere. Ran asks, why can the proof of work algorithm prevent one party from dominating the record keeping? A 51% attack can happen, which means the attacker can change the whole chain. This is a really important question, Ran, and often it's a misconception among many people. A 51% attack can happen. The second part of your sentence, however, is not true, which means the attacker can change the whole chain. No, they can't. The attacker can, using a 51% attack, change the next block, and in fact, be the only one in the long term that is producing blocks, because once you have 51% of the hashing power, you can generate blocks faster than the rest of the network, which means that you can have the dominant chain, which means from the moment you get 51% and into the future, you get to choose which transactions go into blocks. And that gives that miner one very important power. They can cause the network to reorganize, effectively making some of the blocks that were recently mined be reorganized out of the chain and replace them with their own blocks. So they can effectively make a transaction disappear. Only for the recent chain, maybe the last 4, 5, 6 blocks at most. That's why we say that we look for 6 confirmations before perhaps shipping something or allowing a withdrawal from an exchange. And the reason that all of these economic interests on the network insist on 6 blocks, 6 confirmations before assuming that a transaction is irreversible is because in the chance of a 51% attack, you may see reorganizations as big as 6 blocks, but the longer you look, the harder it is. So if you want to do a 1-block reorganization, that happens fairly often. A 2-block reorganization happens very rarely. A 3-block reorganization happens almost never, et cetera, and it gets harder. By 6 blocks, you assume that the amount of effort required to do a 6-block reorganization is enormous. In fact, it involves spending an enormous amount of energy. But here's what a 51% attack can't do. A 51% attack cannot change the rules. And the reason they cannot change the rules is because all of the other nodes on the network that are not mining, the ones operated by exchanges, wallets, merchants, and users, intermediate nodes, everybody else on the network, will not accept the new rules. Meaning that if the 51% attacker starts to operate under new rules, they will find all of their blocks rejected by the rest of the network. And what they will achieve effectively is a hard fork. They will fork themselves into an altcoin that is not accepted by anybody else. The same thing applies about creating fraudulent transactions. They cannot create fraudulent transactions because those transactions and the blocks in which they are mined will be rejected by the rest of the network because every node validates every transaction and every block. Meaning that a 51% attacker cannot change the rules in the long term, they cannot change the rules in the short term, they cannot produce fraudulent transactions, and they cannot produce fraudulent blocks, including blocks that lack the necessary proof of work. And in order to produce real blocks that have the proof of work, in order to sustain a 51% attack, they have to spend electricity, which is why they can't go back and change the whole chain. In order to go back and change the whole chain, let's say they picked a point in the past that was 100 blocks past. To go back into the history and change something that's 100 blocks behind you, what you have to do is remine the last 106 blocks and do that in the same amount of time that the other chain is mining 1 block. That's impossible to do. So you would have to do a sustained attack where you start 100 blocks in the past and then apply 51% so that you can achieve dominance. It may take you 1,000 blocks before you manage to pass, because as you mine block minus 106, the other side is mining block plus 1. Then you mine block minus 105, they mine block plus 2. They're still ahead. Minus 104 plus 3, minus 103 plus 3, minus 102 plus 2. Oh, we're catching up now, but very, very slowly. Minus 101 plus 3, minus 100 plus 4. See, they're still ahead, right? All of this time, they're ahead. In fact, none of what you're mining is being accepted by anyone. Now assume that 1,000 blocks into the future, you finally catch up and pass them, because that 1% difference allows you to mine just a tiny bit faster, 1 minute out of every 10 faster on the blocks you're mining. But because you started 100 in the past, it's going to take you a long time to get ahead. You pass them in 1,000 blocks. The entire blockchain flips over to your side. Now, here's the thing. You managed to get all of that reward, but you only get it once, meaning that you spent all of that energy rewriting 100 blocks into the past in order to get paid a reward. Now, keep in mind, if you have 51% of the mining power, that probably means that before that you had 49%. Until you got to 51%, you were probably mining together with everybody else, which means that out of the 100 blocks that you just reorganized, 48 or so were probably mined by you in the first place, which means you already got paid for that energy use once. Now you spent half of that energy again, and you're not getting paid again, because the second payment is going to overwrite the first one. You have to choose. If you rewrite the chain, you're only getting one of the two chains, the one in which you got paid for 49 blocks, or the one in which you got paid for 100 blocks. But you spent the energy twice, regardless. So you're doing twice the work for half the pay. That doesn't sound very sensible. And that's just 100 blocks into the past. That's not even 1 day's worth of blockchain. To change 1,000 blocks into the past, to change a year of blockchain, it would take more than a year, 2 years, in fact, at 51%. It would take you 2 years to mine 1 year worth of transactions. And at that point, the other side will have mined 1 year too. So it will take you even longer to pass them. So this is why having 51% isn't a winner-take-all scenario. In fact, the amount of stuff you can do with a 51% attack is really limited down to one scenario. That is, you can go to an exchange, you can withdraw the money from your Coinbase transaction that you did, or from a spend that you did on one chain, then reorganize and double spend that money, and then go to another exchange and withdraw it again. So you've withdrawn twice, and the exchange has lost money. Now, of course, in order to do that, you have to manage to wait for 6 confirmations, remine 6 whole blocks, do that secretly without anybody noticing that 51% of the hash power just dropped off the network somehow and is mining secretly, and then pop back onto the network with 6 pristine blocks that came out of nowhere, and hope that the exchange didn't change their confirmation time. Because if I'm running an exchange and I see 50% of the hash power disappear for a few minutes, I'm going to be like, okay, here we go. Someone's playing games. Let's change our confirmation time to 10 blocks just to make sure. Your entire plan is now thwarted. You're going to have to go even further back in order to remine this. Let me change it to 12 confirmations just for the next day or two. Let's see what these people are doing with that 50% hash power that dropped off the network. It is a very difficult attack to do. It is a very expensive attack to do. It is a very risky attack to do. And it has very little possible benefit. Which is why, in the entire history of proof-of-work chains, we only ever see this happen in chains with very, very low security, that are either at the very beginning of their proof-of-work or have had a catastrophic collapse in their proof-of-work due to a fork, and therefore become vulnerable to exploitation because people can shift large amounts of hashing power. It has never happened in Bitcoin, and it's even harder to happen in Bitcoin because in Bitcoin, we have the benefit of dedicated ASIC equipment that cannot be switched from another chain because it's not really used in other chains. And as a result, it's all already in Bitcoin. You can only move it from Bitcoin to Bitcoin, which is noticeable. And that's how the security of proof of work works. Let's check back in the chat room and take a quick little water break, see how things are going. Let me know if you can hear me. I like all the conversation that's happening in the chat room. A lot of what if this, what if that. Great conversation. I'm glad you're responding to each other and having this conversation, because trying to explain it to someone else will really, really help you in your own understanding. So see if you can try and explain why something can or cannot happen, and see what that teaches you, because it's only when you try to explain something that you really understand it. I had to try and explain 51% attacks dozens of times to dozens of different people with different levels of knowledge of Bitcoin. And every time I explain it, I learn and remember and understand something even more deeply. All right. Edmund asked a follow-up. Not sure if I missed this part. How often statistics has a 51% attack happened this far? Allow me to pull up my trusty calculator here on my computer. We're going to need to do some number crunching. So 0 plus 0 times 0 divided by 1 times 0 plus 0 equals 0. 0 times has a 51% attack actually occurred on the Bitcoin network so far. And that tells you something after 10 years about how the security of a large ASIC-based proof-of-work network works. And people who say that proof-of-work through ASICs on a large scale is a waste of money do not understand the security equation. It is not a waste of money. It is money that has been well spent and invested by miners in order to buy us all the most robust system of immutability, security, and protection against double spend that has ever been invented. Hussein asks, why has Bitcoin supply been capped at 21 million and not any other number? There's no reason, Hussein. It's a completely arbitrary number, and it does not matter. One of the fundamental things to understand is that Bitcoin itself is a unit of measurement. It's like saying a meter, right? And if you change the unit, it doesn't change the thing it measures. Meaning that the value of Bitcoin is not determined by the number of units. The number of units is completely arbitrary. I used a similar example today when I was having a Twitter discussion with someone about units. And it's something that's difficult to grasp at first, but assume that a Bitcoin is like a meter, right? So I'm 1.7 meters tall. That means I'm 170 centimeters tall. Is that a different length? No, it's the same length. And that's based on the fact of a meter being about that long. Well, what if we made a meter half as long? Suddenly, I'm taller. Now, at this point, I'm 3.2 of these new meters in height. Have I changed in height? No, we changed the unit. And if you take the same amount of Andreas and fit it in the same number, in the same unit or in this new unit, there's twice as many of these units. So instead of 1.7, you have 3.2. But did the amount of height of Andreas change? No. If you take 21 million of this arbitrary Bitcoin unit, its value is determined by the amount of economy that you measure with it. Meaning that if you take a 21 million Bitcoin and you use it to support a $50 billion economy, that will result in each Bitcoin being about $3,500. If you had 42 million Bitcoin and you used it to measure the same $50 billion economy, that would give you a value of each Bitcoin at $1,750. But there's now twice as many of them. So it's the same economy, just measured with a smaller stick. So 21 million makes no difference. In fact, a lot of people say that this was a mistake in the algorithm. One of the most common mistakes in programming is called an off by one error. And in an off by one error, what you do is you do a loop and you forget to calculate the transition from 1 to 0. In the case of 21 million, if you do the way the 21 million is arrived at is you start with a certain number of Bitcoin per block, and then you do half of that and half of that and half of that and half of that. So it's a sequence that is divided by 2 each time, and that's a limit sequence, and you can calculate it, and it ends up being 20,999,999 Bitcoin plus some change. Some people say that Satoshi in his original implementation had intended to produce 42 million, which is exactly twice that number of coins, and had assumed that there would be one less halving, which if you had one less halving, you'd have half as many Bitcoin being generated, most of them in the first period. And as a result, there would be 42 million total. 42, of course, being the answer to the question of life, the universe, and everything, according to the book The Hitchhiker's Guide to the Galaxy by Douglas Adams, which is one of my favorite books. And it's completely ridiculous geek lore, and it might be completely coincidental. 21 million might have been a number that was important to Satoshi. It doesn't matter. None of that matters. The unit is irrelevant. So why was it 21 million? This is where we go into numerology. So it's a mystical number. It wasn't until January 3rd, 2009, but from now on, it will have significance. People will say, why is your 21st birthday special? Because there's 21 million Bitcoin. Adirman asks, considering the huge computing power of the coming quantum machine, what will be the risks for the Bitcoin network and the integrity of transactions? Could an institution or a state having such quantum technology undermine the Bitcoin network? Yes and no. Yes, in that quantum computing threatens the ability of the elliptic curve digital signature algorithm to maintain its security. Theoretically, at least, a sufficiently powerful quantum machine can do the discrete logarithm problem that is at the core of elliptic curve cryptography, and therefore it can reverse a public key into a private key, theoretically. One, it requires a quantum computer that is several order magnitudes bigger in terms of how many qubits it can operate at than anything even theoretically discussed at the moment. So that's unlikely to happen anytime in the near future. In fact, the ability to do more qubits has not been increasing linearly. It's actually decreasing over time. So it's getting harder and harder to add more qubits to quantum computers. We might never get there. Who knows? Never say never in technology, but it's a long way out. Secondly, one of the interesting innovations in Bitcoin is that public keys are not actually included in the blockchain until a transaction spends an output. So it's only in the signature that spends an output that a public key is shown first, which means that if you use every address only once, and when you spend it in full and send the change back to a different address, which is how almost all wallets operate today, the moment the public key is visible, and before it can be cracked to reveal the private key, that private key already controls 0 Bitcoin because it's already been spent to a different address. The address itself is a double hash, and hashing algorithms are not as quantum sensitive as the elliptic curve discrete logarithm problem, which means that a quantum computer cannot make hashing significantly better to the point of breaking Bitcoin addresses. At the same time, a quantum computer also won't help mining much. And finally, it depends on the degree of development of quantum technology. It would have to be a degree of quantum technology that is not only available to a state actor or institution, but also unavailable to everybody else. Because in order for that kind of attack to be usable, we would have to not have quantum computers of our own that allow us to implement quantum digital signature algorithms that are uncrackable by quantum computers. So if quantum computing does happen, but it also happens in a fairly broad way, meaning that most organizations, institutions, and commercial entities have access to quantum computing of roughly equivalent magnitude, with the exception of a couple of state actors that have a couple of orders of magnitude more powerful quantum computers. Then we implement quantum algorithms for digital signatures, and the network is secure. And at the same time, you've got to understand that if a state actor has access to quantum computing that can break elliptic curve, Bitcoin is not the target. The target is military-grade communications and fire control systems that control nuclear weapons that will only ever be used as a last resort, meaning that at that point, keeping the secret that you have a quantum computer that can disable your opponent's nuclear stockpile or its command control communications or its military-grade satellite control systems is the biggest secret you ever had. And as a state entity, the last thing you're going to do is waste that secret on stupid little Bitcoin. So don't worry about quantum computing. This is not an issue that we need to worry about now. It's not an issue that suddenly becomes an issue without anybody noticing, and it's certainly not an issue that cannot be engineered against. And the final question for the day comes from Matthew. What are the possibilities of creating new ways to solve the Byzantine Generals Problem other than proof of work, proof of stake, etc.? There are lots of possibilities of creating new ways of solving the Byzantine fault-tolerant systems. Each solution has different trade-offs. So you're optimizing for different things. The question is, which algorithms deliver the best set of trade-offs for the application that you're interested in? For example, proof of work as a solution to Byzantine fault tolerance delivers a very great degree of decentralization of control, as well as a very strong constraint of immutability on the past through the expenditure of energy, meaning that because proof of work requires energy, solving the Byzantine fault tolerance problem with proof of work ensures that the past cannot be modified without expending significant energy, which puts a constraint and gives you an additional feature, if you like, of proof of work systems, that they are strongly immutable. Proof of stake has different constraints. It has different characteristics than proof of work. Other systems, various Byzantine fault-tolerant algorithms exist, dozens at this point, and they also present different trade-offs. Could a better solution eventually emerge that makes Bitcoin's proof of work mechanism irrelevant? Absolutely. And if it had strong immutability characteristics and strong decentralization incentives, then that might be a great candidate to upgrade into Bitcoin. It would be difficult to design a system that could compete against Bitcoin because of network effect of first mover advantage. And in fact, the miners would strongly resist changing the algorithm because changing the algorithm obsoletes all of the equipment they've already purchased. But it's not unthinkable. And there may be circumstances under which the entire network decides to upgrade. Or if this solution is outside of what we call Bitcoin today, and some other system develops a better algorithm that has stronger characteristics for decentralization and immutability, I'd be interested in experimenting with that too, and maybe others would too. In any case, there's nothing sacrosanct about the engineering trade-offs and technologies used in Bitcoin. They serve a purpose. And if you can serve that purpose by a different means with better outcomes or better trade-offs or different trade-offs that apply to different applications, then there may be very good uses for those too. This is not a system where one choice made once is the only choice that could ever be made or is the only choice that should ever be made. However, right now, proof of work is a system that delivers excellent characteristics of decentralization. It is extremely robust to attack, as we've seen again and again and again, especially at the scale of the Bitcoin proof of work network today with its 45 exahashes of hashing power. And it provides a level of immutability, a difficulty of changing the past that is greater than any other solution to the Byzantine fault-tolerant problem, the Byzantine Generals Problem. And so for that reason, proof of work is, I think, the ideal system for Bitcoin in its use as sound money. And with that, right on the hour, we are out of questions, and great timing. And let's go straight up to the chat room. Make sure I didn't miss anything. All right, I think I got everything. Hello, everyone. I saw people joining from all around the world, people from Athens and Chile, people from Germany, people from India, and many other places around the world. Thank you so much for participating in this, the 11th iteration of the massive open online course for the master's degree in digital currencies by the University of Nicosia. This is your host and lecturer, Andreas Antonopoulos. I've been answering your questions. These questions come from the forum, and they're moderated by my associate, Andreas Vlachos, who's doing a fantastic job. Thank you, Andreas. And so if you want to participate in this Q&A, it's important to come and join the video and ask questions on the chat if you have a follow-up, but I'm not going to answer questions that have not appeared or are out of topic. So please ask your questions in advance. You have all of next week to study the material, to study the questions, to ask questions, to discuss them amongst yourself, to refine the questions, so that then at the end of the week, I can jump in and answer the best questions that have been moderated by Andreas and given to me, and we can do follow-up on the chat. Thank you so much. It's been a pleasure teaching for you and answering your excellent questions. See you next week. Bye-bye.